think this is where a lot of people get this stock wrong, is when you look at it through the eyes of a traditional legacy OEM, BMW, I think, is the most profitable OEM out there. And they're at half the margins of that of operating margins, too, of Tesla. And so I think that's what keeps surprising people. And I think they're getting surprised because they're looking at it, quite frankly, the wrong way.
And the growth was, almost out of this world, almost like a SpaceX.
During my years at Tesla, I can't tell you how hard it is to double a business at this scale in hardware. And Tesla's been doing this for years. And now they're, at this scale, still growing at 87%.
And we really think that this is very early on in the Tesla story, really only in the first or second inning.
In this video, the Wall Street stock analyst and the mainstream finance media react to Tesla's stunning, of course, not actually if you're following closely, but if you weren't, stunning Q1 2022 financial results. So let's get into the video. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks. Check out the links in the pinned comment below. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. You can also pick up some Tesla, Elon, and investment theme merch in the merch store. So check out the links in the pinned comment below, and thanks for your support.
Flat is good when you have a facility shut down for 3 weeks. So I think that came as a surprise. And I think the margins also, ex credits, much better than expected. And so, when you just kind of look at this in comparison, and I think this is where a lot of people get this stock wrong, is when you look at it through the eyes of a traditional legacy OEM, BMW, I think, is the most profitable OEM out there. And they're at half the margins of that of operating margins, too, of Tesla. And so I think that's what keeps surprising people. And I think they're getting surprised because they're looking at it, quite frankly, the wrong way.
This is a deceptively simple but important and accurate point. The reason people tend to get Tesla wrong over and over again is because they don't know what Tesla is. They project their own assumptions about the company, look through a certain lens, and therefore, it's an auto company. This doesn't make sense. I don't get it. The valuation's insane, therefore overvalued, rather than going from first principles and trying to understand what Tesla actually is. A lot of these folks seem to be suffering from too smart for my own good syndrome. That being said, personally, Tesla's increasing gross automotive margins, not a surprise to me. I'm not sure why anyone would be surprised. Spoiler alert, just to avoid surprise in the future. Ready? Over the long term, Tesla's margins, their gross automotive margins, will continue to trend up. Certainly, there's going to be a few bumps along the road as different factories ramp, blah, blah, blah. But over the long term, Tesla's margins will continue to increase. So here's the fair warning. If you're surprised by Tesla's margins increasing over the long term, it's not because Tesla did something unexpected, it's because you didn't do enough thinking and or homework. This trend is pretty clear. Tesla continues to drive their costs down, they're benefiting more from economies of scale, they have insane demand, electric vehicles are very new technology, there'll be huge innovations in manufacturing and driving costs down, blah, blah, blah. Like, this is inevitable, this is obvious, even at the most basic level. Electric vehicles have so few parts versus an ICE vehicle that in theory, by default, once they ramp to similar volumes, they're going to be much cheaper to produce because there's less shit going in each vehicle. The reason people are being so surprised by Tesla's increasing margins is because they're not thinking. They're going, oh, they're a car company. No car company's ever had margins like that. Therefore, Tesla can't have margins like that. The end, I don't need to think anymore. We know how that's been working out so far. You guys will find videos that I posted on this channel 2.5 years ago saying that Tesla's margins are marching steadily toward 40%. It sounded insane at the time. Still sounds insane to people who think Tesla's a car company. We'll just have to wait and see.
So what is that? What does this do for valuation, especially with the margins like this and the profitability surprising in a good way?
There's no question that the macro is going to be under pressure. And so relatively speaking, we're going to see what Mike was just talking about in terms of these fits and starts with the market. But I think when you look at it from a category killer perspective, in this, we got to bring in a little bit of history. If we go back to 1908 and we look at Ford, they had 9.8% market share. By 1914, they had 50% market share. And so the question then becomes, when you look at an Apple, you look at an Amazon, what do you pay for a category killer in this? And that becomes, less of a science and more of an art. Right now, we have a 35 times EBITDA. By any means, that's going to be argued that that's expensive. But when you look at what they're posting and how they're really changing this category, it's hard to argue that traditional valuation metrics were what you should, how you should value Tesla.
Once again, Jed, absolutely spot on. This is one of those things that I really struggle with. I don't, honestly, and I genuinely mean this, by the way, I'm not here to just shit on Wall Street analysts or retail investors, but I just don't understand how anybody can actually make an attempt to understand what Tesla is, do enough digging that they feel comfortable that they understand what they're looking at, and conclude that Tesla's just an automotive company, they're just a car maker, and therefore they should be valued exactly the same way. Do these people not understand what Tesla is doing? Do they not see the innovation in manufacturing? Do they not see the software prowess? Do they not see the technological leap? Do they not see the innovations in manufacturing? Do they not see what Tesla is doing? Do they not see the incredible engineering? Do they not see how resourceful this company is? Do they not see how lean they are in terms of capital expenditure versus the actual scale of the company? I just don't get it. I really don't.
You, like all of us, probably thought, wow, that's pretty amazing to circumnavigate the supply chain issues to this extent. How did that happen?
Yeah, Joe, this was a big surprise. As Phil just said, they not only hit the ball out of the park, it seems like they hit the ball out of the parking lot. The supply chain issues, they're very adept at looking around corners. They've got incredibly bright people on their supply chain, but the chip shortage that slowed down most automotive manufacturers didn't slow them down. And that's largely because they can take what chips are available in the market and rewrite their software and use whatever chips are available to them. The other automotives don't seem to have that capability.
If you're a regular viewer of the channel, or if you've been following Tesla for a while, none of this will come as a surprise. We know Tesla has incredible capabilities, but I do want to dwell on this point for a moment because this is really worth emphasizing. It's not just one or two areas in which Tesla has capabilities that other automotive manufacturers simply do not have. It's across the fucking board. The global chip shortage has given us a window into some of the abilities Tesla has that other companies do not. Their ability to rewrite firmware, get new chips, and just figure out how to continue producing vehicles is great, but this is just a tiny sliver of what makes Tesla different versus other automotive companies. How many other automotive manufacturers have the capability of inventing a brand new, industry-leading, world-changing battery cell? Oh, that's right, none of them. How many other automotive companies have the capability of selling billions and billions and billions and billions of dollars worth of product without any advertising spend whatsoever? None. How many other automotive manufacturers have the capability of deploying a fleet of vehicles to collect data to improve their autonomous software? Oh, that's right, none. How many other automotive manufacturers have Tesla's software capability? None. How many other automotive manufacturers have designed their own neural network training chip? None. How many other automotive manufacturers have the capability of making the world's safest vehicles? None. I could literally make an hour-long video just asking these questions over and over. How many other companies in the automotive industry have this capability that Tesla has demonstrated? And it'll be none, 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 none. The chip shortage, the supply chain challenges have been a tiny window. This is a huge clue for smart investors.
Margins also, the sales number just nominally, and the growth was, almost out of this world, almost like a SpaceX. But the margins,
doubling
the legacy, double the legacy producers, the margins.
You're absolutely right. During my years at Tesla, I can't tell you how hard it is to double a business at this scale in hardware, and Tesla's been doing this for years. And now they're at this scale still growing at 87%. And as you said, their profit tripled to $1.1 billion, but their gross profit margin at 30% ex credits is double GM and Ford's. So they're not only executing at the top line, they're executing at the bottom line as well, which is really impressive. The robotaxi challenge is a very hard challenge. However, what a lot of people don't understand is a robotaxi is worth about $250,000 of profit. So if they're successful, that completely changes the car business from a one-time sale where you're making $8,000 to $10,000 of profit per car, and you're producing a car that can generate 31 times the profit. That's a goal. What a lot of people don't understand is Elon, when he makes these statements in public, is largely intending to motivate his internal team and point them at the next hill or the next horizon. But I think for long-term investors, that's not where I would place the value of this company. We're in the very early innings of electric vehicles. This company can grow to be 5 or 6 times its size over the next 10 years just in electric vehicles, ex-robotaxis, ex-robots. it's a very, very attractive business.
That's right. Tesla today, at relatively small scale versus their longer term goals, already twice as profitable as government motors. And yes, the robotaxi business, should Tesla be successful, and I'm highly confident they will be over the long term, is going to absolutely dwarf Tesla, the automotive business. We heard some rough numbers there, almost a 40 times increase in profit per vehicle with the robotaxi fleet up and running versus just selling cars to consumers.
Melissa, the key takeaway is traditional auto just can't keep up with Tesla. And there's 2 points I want to enumerate. First, on the profitability standpoint, I agree with Karen completely, is that this upside on the critical gross margin ex credits number was based on higher margin, the higher margin performance SKUs. The price increases that we've seen had little to do with this beat because those price increases come when deliveries. Many of those deliveries are pushed out 3, 4, 5 months. And so we're going to see that price increase layering forward. So when we think about the gap between Tesla and traditional auto, just beyond the specifics of the numbers, is that the profitability and why are Tesla consumers paying up for these performance models essentially to jump the line to get them sooner is because they want their products and other automotive companies just simply don't have that demand for their EVs.
Gene Munster is absolutely right here. I mean, this is an inarguable point. We need only look at the data. The fact that Tesla's been able to and has raised prices on most of their products by 20-ish% over the last 12 months, yet customers still willing to wait 6, 9+ months to take delivery of their vehicle because they're so compelling. People don't want to buy anything else. Really speaks volumes.
And second is what happened with their tax credit revenue. This is a metric, a line item that largely gets ignored. It's basically when Tesla sells these compliance certificates to other automotive companies that aren't making enough EVs. And the quarter was 690 million. Last quarter was 314 million. They had been giving guidance that that number would decline over time as more automotive makers, the traditional ones, made more EVs. They wouldn't need to purchase these credits. And so ultimately that surprise is testimony to the strength that Tesla is having competitively. So I think that the takeaway is it's not a good spot. This is not a good quarter for traditional auto.
Munster's right. Once again, talk about flipping the script here. Tesla's stunning quarter, insane automotive margins, huge profit, crazy demand, blah, 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 is a terrible, terrible quarter for legacy automotive manufacturers. Just imagine you're a CEO of a legacy automotive company and you're not a completely and utterly brain-dead moron, so probably excludes a few, let's be honest here. You see Tesla absolutely slaying it despite all the supply chain challenges. You realize, holy shit, their demand's insane. People are waiting up to a year to take delivery of their vehicles. They're paying 20% more than they were a year ago, and nobody wants to buy ours. At some point, the penny's got to drop for these companies. I'll take Gene's comments a step further and suggest that this quarter was even worse for legacy automotive manufacturers than it was good for Tesla.
Gene, I'm curious to whether or not you think what's going on in Shanghai, the shutdown, will affect ultimate numbers for the second quarter and for the year.
I don't know too hard on Melissa here. I mean, obviously this is just a conversation starter, but of course it's going to. The fascist shutdown means zero production from Shanghai for a period of multiple weeks. Obviously that's going to have a major impact, but we heard on the earnings call, Tesla believes that Shanghai could get to record weekly production by the end of this quarter. So a blip in the radar, a big blip. This may impact Tesla to the tune of 100,000 vehicles, give or take, when you factor in the shutdowns plus the slow ramp back up to volume. But as we heard on the earnings call, Tesla's still highly confident of 50, even 60+% annual growth in deliveries despite the shutdowns.
It will. We're obviously going to hear some of that on the call. My guess is it's somewhere between 30 and 40,000 vehicles, assuming that things get back up and running in early May. That would amount to about 2.5% of total deliveries in 2022. So it is measurable, but it is transitory, assuming I do believe it's transitory, and I think investors are largely going to look past it.
And Gene, when we think about Tesla versus the traditional automakers, are we in the Tesla deck, what struck me was sort of them highlighting the advantages they have in terms of their in-house production, the simplification of the production process, fewer number of parts that are cast, the 4680 in-house cells that were delivered with cars for the first time out of Texas. I mean, these sorts of things, it seems like it's a deeper moat versus some of the traditional automakers. Or do these other automakers also have that sort of technology in the works?
First, Melissa, I'm impressed at just the level of detail there. Second is that there is a distinction, a gap And I would just simply look at 2 videos. Look at the video, do a video flyover a drone, some video of Gigafactory Texas. Compare that to GM's new electric vehicle factory that they just came out with. It is about as stark of a contrast. And one example looks like something out of the 1980s from GM with humans moving things around. When you look at how Tesla is done internally with their robotics, it looks like something out of the Terminator, some science fiction movie.
This may actually be the best thing I've ever heard Gene Munster say about Tesla and legacy automotive companies. Rip General Motors, their factory looks like something out of the 1980s versus Tesla, something out of a sci-fi film. He's right. Well said.
This is the detail, and this is what goes beyond, I think, again, I think getting, in my view, is overly focused on some of the metrics, understand why they're important. But the bigger picture is what you're talking about on the production side, the machine that makes the machine. That also is something that doesn't come through in these numbers tonight. You don't see it. But if you if you work at one of those other automotive companies, that's what you're thinking about tonight is that factory and wondering how in the world am I going to compete with that?
Karen, how are you feeling about traditional automakers?
Not good, not good. It's just funny, though, Gene. Look at the brain on you, Harvard girl. You impressed him. I mean, not surprising to all of us who know you. But no, not good. They're just way ahead. And, the valuation chasm has gotten even bigger, if that's even possible. Mathematically, at some point, I would think it can't be possible any longer. But as it should, that is the direction it should go, no doubt.
Or is this the moment, Dan, where Tesla's on the cusp of facing very steep competition that everybody else is underestimating?
That's what Michael Burry thinks. I mean, listen, I don't mean to sound so churlish about the story. Someone just tweeted at me that says Dan hates Tesla. I don't hate Tesla. He's obviously doing an amazing job. They're executing. I actually hate the stock. And I've been in this business for 25 years, and we've seen stocks like this before. Maybe not get to $1 trillion based on this sort of sentiment, based on the founder, based on the period in which we are and feeling about the disruption within a specific industry. Every single time they come crashing down. Every single time. So it really is a matter of timing. And the stock has really only worked for the last 2 years, okay? Now, it's worked to the tune of $900 billion, okay? So a lot of people have made money on it, but it only actually makes them kind of get that much more into the story, which actually presents more risk. So I think buying into it here based on the best quarter they've ever had after the stock has gone up 900 points in a year and a half doesn't make any sense. Now, every step of the way, you could have bought every dip and you'd be making money, except the last 2 months. But here's the thing. Let's see how it acts tomorrow. I don't know. I mean, maybe that's as good as it gets.
I think Dan has just raised his hand to win the award for the dumbest human on the CNBS panel. Quite an achievement, by the way, not everybody. Some of the folks on there really get it, Melissa Lee among them. But we just heard Dan here self-immolate, won't age well. This guy, for the record, was an anti-Tesla since day one. There's some hilarious comments from this guy going back years on Tesla, the valuation, buying into the Tesla Q thesis, and so on. Here's the fatal error of reasoning or lack thereof that Dan is making here. I've been investing for 25 years. I've seen this happen to so many other stocks. Hey, Dan, you have never seen a company like Tesla ever. You, unfortunately, are projecting what you've seen happen to certain stocks and assuming, this is one of those again, instead of reasoning from first principles. Don't know how else to say this. I mean, Dan's obviously a dumbass. Now, might be smart in other areas of life, but understanding what Tesla is not one of his strong suits. Notice, Dingbat Dan had nothing whatsoever to say about Tesla's profitability, their rate of growth, their technological advantage, their engineering talent, their software capabilities, nothing at all to do with the company, just reasoning by analogy. I saw stocks go up in the past a lot, and then they crashed. Therefore, Tesla's doing the same thing. I just don't know how to respond to this level of stupidity with anything other than ridicule. This guy's an emotional investor at best.
Colin, a lot of the material being written today suggests that they once again put a little more white space between them and their legacy competitors in terms of operational efficiency. Is that fair?
Absolutely. And this has been building for multiple years. This company is rooted in materials and software engineering. We're seeing the net result of that. That's been, over a decade in the making. And they're really changing processes, fundamental design of these vehicles. And I think transitioning from not just an automaker into a full-blown data-driven company that's monetizing their insurance, as well as their FSD, which is really leveraging all of the cars that they have on the road.
Brian, we talked a bit about this morning about how to value it now on earnings or something else. How are you getting to your target price right now?
I can't deny that they've actually executed quite well as a premium automaker. I think there are some headwinds ahead. We'll see how 2Q plays out between Shanghai shutting down and commodities. I just think when you look at the gap between the $1 trillion valuation and our $300 billion target valuation, there's a lot of fluff built in around robots, robo-taxis, energies, which are all very speculative.
Brian, what would it take for you to actually change that rating?
I'll take that one. A brain transplant. Now, no disrespect, I'm just kidding. As much disrespect as humanly possible to Brian Johnson, one of the worst stock analysts in the history of stock analysts. I'm not even kidding. Let's check out the rank on tipranks.com here, keeping this clown accountable. Rank number 7,695 out of 7,938 analysts on TipRank. Success rate less than 50%. You'd be better flipping a coin picking stocks. Average return minus 7%. Talk about a clown show. He's like an anti-index fund here. Most people happy with 7% return per year with an index fund. How about negative 7% per year? Yeah, that's right. Brian Johnson, he's your man. By the way, nothing personal here. You can be a complete and utter fucking moron when it comes to Tesla stock and stocks in general. Case in point, Brian Johnson, literally that. But you can be a great person outside of that. Never met the guy, nothing personal, but dude, just give up. Seriously, give up. Look at this guy's track record on Tesla stock, okay? Been covering it since 2013. Had a buy rating initially in 2013, then a period of a few years of holding. Then suddenly, from early 2016, exactly when I started buying Tesla stock and haven't stopped since, he's been sell the entire time, whereas I was buy the entire time. The success rate on the stock, about 1 in 4. Bit of luck due to Tesla's volatility. Average profit on stock, minus 97.5%. I'm really big on accountability and credibility. Brian has none of the latter, and I mean none of the latter. It's almost impossible to be worse than Brian here. I mean, it takes skill to be this bad at understanding stock. It takes skill, okay? To be the top 2%, top 1%, top 3% at anything is equally as difficult as being the bottom 1, 2, or 3%, in my opinion. It's like being an Olympic gold medal level moron. Again, nothing personal, but when it comes to Tesla and stocks in general, Brian, dude, you need another career. Stat. Have you guys noticed my complete and utter disdain for incompetence?
Well, this is what I think the company is worth. Now, that being said, we try to make trading calls in our notes, and I would point out that it's a very difficult stock to short as long as the narrative of executing well as an automaker is continuing, which I can't deny. It doesn't really have, we think, a Netflix, Facebook kind of moment till sometime in 23, where we see if all the capacity they're adding in China, in Europe, and in Texas can actually be sold at the kind of margins we saw in 1Q and the kind of volumes that those factories would need.
Oh man, I feel so bad for this guy. I mean, I really do. He's trying his best. He just doesn't get it. Again, it's never personal here. I'm attacking the ideas. He's got no idea about Tesla. He's genuinely doing his best. He just can't grasp it. But this is the point. If you've been so wrong, consistently butt your head up against the wall, consistently punching yourself in the face, at some point, don't you take a step back and go, maybe I just don't get it. Maybe I shouldn't be covering this stock. Maybe I should give this to somebody else who seems to get it a little bit more. I just don't know what else to say. I don't know what to do. How do you help somebody like this?
Finally, Colin, last night he talked about new production facilities being launched in a period where they're smarter than they were, for example, when they first got Shanghai underway. I wonder if you think that learning curve continues to slope up.
Yeah, I think there's still another couple of legs to it. Clearly, going from Fremont into Shanghai was a massive change for the organization, and we'll see how things go with both Berlin and Austin. But clearly, they've demonstrated a history of learning from their mistakes, and a willingness to make those mistakes.
Something, learning from one's mistakes. Colin, was that a low-key suggestion to your colleague here, Brian? And again, not personal, but dude, when you are that bad, I'll roast the absolute fuck out of you. It's your job to understand this stuff, to make recommendations, and you are so embarrassingly wrong. You should be held accountable.
So as we go forward, we're expecting them to continue that learning process, and I think the leaps are going to be a little bit smaller, but I think they've, at this point, with the changes in the design and the process, are getting to a place where they're just going to accelerate the volumes and continue to drive costs lower, which I think does continue to drive a lot of margin here over the next 4 to 5 years.
And we really think that this is very early on in the Tesla story, really only the first or second inning.
Yeah, so Eric, I'm curious, what do you think of this disconnect between sort of your traditional Wall Street analysts who have been behind this trade for many years and yourself and the ARCs of the world that are, looking to the future? Why do you think that Wall Street isn't, counting the idea of robo-taxis, which Elon Musk said last night is going to be cheaper per mile than a subsidized bus ticket? Is there just a disbelief that he can actually do it?
So I think in general, what I would say is that we consider ourselves outsiders, which really, I think, gives us an advantage. What we've seen historically is on Wall Street, a relatively superficial level of research. I think Wall Street tends to go pretty wide, and our advantage comes on going deep.
Now, this is a sharp point. How many of the Wall Street stock analysts, traditionally from the automotive world, do you think have gone deep on Tesla, who've spent the time, the months, trying to understand neural networks, artificial intelligence, deep learning, importance of data, Tesla's autonomous strategy. How many of these folks do you think have watched every discussion between James Dowmer and Dave Lee? How many have a basic grounding in physics and therefore can understand manufacturing efficiencies in the future by driving costs down and innovation in the process of building electric vehicles? How many of these analysts have been discussing Tesla's OPEX, operating leverage, and the obvious increasing in margins over time? How many of these folks do you think have spent time watching Sandy Munro's teardowns? I surmise that it's very few. One final comment about breadth versus depth. Have you guys and girls noticed a little bit of a correlation between people who tend to understand Tesla relatively well? And by understand Tesla relatively well, I mean putting their money where their mouth is. They're not just talking smack, oh, this is my opinion, that, but they're actually putting their own money on the line and their willingness to go ultra deep. And just a quick side note on this whole concept of depth. One of the funniest things I occasionally see in comments is people under the false presumption that I have no idea what I'm talking about. All I do is speak in hyperbole. I've got no idea. I haven't done any homework, no analysis whatsoever to do with Tesla, because these people unfortunately are lacking in sufficient mental capacity to understand that there is actually a little bit of strategy, a little bit of method to my madness here on YouTube. One, we've already got great resources like Tesla Daily, and two, there's a certain subset of people who will fall the fuck asleep if we're just talking about spreadsheets and EPS. Per my Twitter profile, my goal here is to be a gateway drug to Tesla. Most people couldn't fathom how deep my understanding of this company. Were I to convey this level of understanding, it would be so dry that people wouldn't be tuning into this content. Of course, history, and by history I mean my financial results, will speak for themselves over time. But I do find this amusing. Occasionally this same comment comes up and all I can do is laugh. Imagine being so dumb, so thick, so daft that you don't understand that there is actually some strategy involved in creating content.
And so when we own a position, and we want to own positions really for the long term, we need to go super deep into the analysis to find a variant perspective that ultimately is differentiating from Wall Street's perspective. And we love to find these scenarios. I mean, we love to find scenarios where there is a really wide dispersion between our belief of the future and the growth and consensus expectations. And the wider that dispersion, the more arbitrage exists for us to exploit as long-term investors.
Well said. This really is an arbitrage opportunity. The depth of understanding as an investor, if you really, really go deep into the weeds, spend the few years it's going to take to understand everything applicable to Tesla. And I'm not talking about the automotive industry. I'm not just talking about manufacturing. I'm talking about everything. The software component, AI, neural net, everything. You have a massive advantage. This is why I constantly take a dump on the Wall Street stock analysts, because I know they haven't gone to the same depth. They don't understand Tesla at the same level that I do. Yes, there's a couple of exceptions. Colin Rush, Oppenheimer among them. Alex Potter, another great example. Despite outward appearances, I'm highly confident. If you put me in a room with 1,000 people who believe they understand Tesla, I will know Tesla better than every single one of them. 10,000 people, same story. Maybe 100,000 people, okay, now top 3, maybe top 5 at best. In the defense of these Wall Street stock analysts, their job is to be an absolute stock slut. As an analyst on Wall Street, you're not really going to be too much use to your company if you're covering a single stock. That's why I have a massive unfair advantage. The same with Rob Maurer of Tesla Daily, Dave Lee, and so on. Each of us has been following this company intimately for a decade plus. You just can't compete with that level of depth and understanding. The deeper you go, the more you understand Tesla. As an investor, the more you start to realize the huge disconnect between reality versus consensus opinion. Again, this is arbitrage. This is an enormous investment opportunity, in my opinion. I think the mistake 99.999% of investors make is they think they've gone deep enough, but they haven't gone all the way. It's almost a bit of a Dunning-Kruger type of effect here. Like, oh yeah, I know everything I need to know about this company. There's no point learning about this, that, or the other. I know everything I need to know. Here's my judgment. Here's my decision. Next minute, I've been wrong for a decade straight on this company. Of course, talk's cheap. I can sit here all day and tell you guys and girls that I understand Tesla better than most people on the planet. I'll be right, but you don't have to take my word for it. The only thing that matters, it's not my words, it's my actions. What have I been doing with my own capital? And more importantly, what's my investment horizon? And over that horizon, what are my ultimate returns? Obviously, anything could happen with my investment in Tesla stock in the future. But again, on the record, I've been buying nothing but Tesla stock for about the last 6 years in a row. No intention of changing that anytime soon. As I keep banging the drum with my Tesla stock price targets, I think we have an enormous way to go from here. Worst case, 10x over the next decade. Of course, could be wrong. Probably won't be. Confident enough to say that out loud, and I'd like to be held accountable. But I also believe there's scenarios in which we could see a 20, 30, 40, or even a 50x in Tesla's valuation over the next decade, maybe decade and a half. But don't take my word for it. Just wait 10, 15 years and see what happened. It is my uninformed opinion that irrespective of your risk profile, the more you, as an investor, understand Tesla, the higher a proportion of your net worth Tesla stock will comprise. Just saying.
Eric, I wonder if you're surprised at, I would argue, maybe the lack of Musk copycats, people who are stealing pages from his playbook, either from a production standpoint or a capital raise standpoint or a marketing, a troll, even Twitter troll standpoint. And if there are some, who would you look to first?
Yeah, I think that what I found shocking, so a colleague and I went down a couple of weeks ago to Austin, Texas to take a look at the new factory, which is a pretty incredible facility. And one of the more shocking elements to me was not just the scale and some of the core engineering and innovation that's happening there, is that they simply opened it up for everyone to see. And I thought that was such a move of confidence to show some of the most profound, groundbreaking, cutting edge manufacturing techniques. And Tesla just invited the public in to see it. And I think that speaks to the confidence and the maturity of this business. And ultimately, that factory combined with Giga Berlin, Giga Shanghai, and the expansion of Fremont, we're very early in this growth curve from our perspective.
Right. I also think it's interesting, he gets knocked around a bit for past projections or forecasts that maybe were late, right? Obviously, his robo-taxi prediction is still late. But I wonder if you think at least the street is coming around to the idea that, all right, maybe the date that he gives on a certain target is questionable, but he's going to get it done eventually.
Yeah, to be clear, from our research, we do believe that Tesla will achieve an autonomous robo-taxi network. I think one of the core mistakes that many investors seem to make, from my perspective, is they disbelieve Elon. And I think that this is an individual who has really cultivated a culture of innovation that exists in all of his firms, not just Tesla, but we see it at SpaceX as well. And so, frankly, when we just go back to our valuation, again, this is all our analysis, our opinion, not financial advice. Our 10x by 2030 valuation assumptions do not include robotaxi, and they also do not include other real-world AI products.
This is another great point. One of the biggest mistakes, possibly the single biggest mistake investors make, is disbelieving Elon Musk. And I've talked about this in the past. I don't really think there's any explanation for this other than some mental health issues. And I'm not making light of mental health. This is a major, major issue. But I can't understand how somebody can look at what Elon Musk has accomplished, see all of these examples in different companies, different industries, disruption, leading teams of incredible engineers doing the impossible over and over and over again, and think the Tesla bot's just to pump up the stock. They're not serious about that. They'll never do that. Or to not understand their strategy with autonomy, or to assume because Elon Musk has been late in some of his predictions about brand new technologies that have never been done before, that he's intentionally deceiving or lying and therefore cannot be trusted. I genuinely don't understand how anybody can disbelieve Elon Musk without some mental health issues or some form of delusion. This is the only reasonable explanation I can come up with. For whatever reason these folks see Elon Musk, they misjudge his character, maybe because they're projecting what they don't like about themselves onto Elon. Maybe his success in life makes them feel bad about the fact they're still living in their mum's basement, and their emotional response causes them to be blind to the reality. Elon Musk is unquestionably one of the world's greatest engineers, and without a doubt, the world's best businessman ever. No one has a history of executing like Elon. No one. And for somebody who's separated by Elon Musk by 6+ standard deviations, to doubt this guy, to distrust and to disbelieve, it's just hard to find any reasonable explanation other than some form of delusion. I think the key takeaway here is, rather than dismiss or disbelieve, try to disprove. Rather than jumping to conclusions and making assumptions, which are prone to make you look like an absolute moron, try to prove or disprove something. Why is this possible, or why is this not possible? Why is this inevitable, or why will this never happen? Dig deep enough until your beliefs are on a very solid foundation, else maybe reserve sharing your opinion, lest you be roasted and embarrassed consistently by some dickhead on YouTube. Good news, it's pretty clear overall, people are starting to understand Tesla a little bit more than they did just a few years ago. Still got a long way to go, but things are trending in the right direction. Anyway, I hope you guys and girls have enjoyed the video, and as always, don't forget you can join Patreon with the card in the corner and the link in the description. You'll instantly gain access to 100+ exclusive Q&A videos on loads of topics, dozens of other exclusive pieces of content, loads of perks, and instant up-to-date access to my Tesla stock price targets out over the next decade. So, I'll see you over there. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.